The MACD is very popular among traders, yet there's more to using and understanding it that meets the eye. The MACD uses moving average lines to illustrate changes in price patterns. MACD is a great indicator to confirm the setups, to locate and follow the trends, no matter what trading system you trade. Among all the signals or patterns that MACD makes, the MACD divergence is my favorite and the most reliable leading signals I could get. A divergence in general occurs when the price action is seeing lower lows while in a downtrend, but the indicator is not reflecting that move. Similarly, when the markets are trending higher, you notice divergence when the price action is seen scaling higher highs, but somehow the indicator remains firm on the change and forms lower highs. So when the price of an asset, such as a stock or a currency pair, is moving in one direction and the MACD indicator line is moving in the other, that's a divergence. This type of signal is supposed to warn of a price direction reversal, but the signal can be misleading and inaccurate. Another type of divergence is when a securities price reaches a new high or a new low level, but the MACD indicator doesn't. Essentially, what it conveys is the shift in the market momentum. After all, the markets are driven by momentum, and the momentum is the force that oscillates between highs and lows, and thereby bringing the changes in the price action. Traditionally, this would indicate that the price direction is losing momentum and is priming for a reversal. But by its own, this can also prove to be an unreliable trading signal. While you don't need to understand the math that underlies the calculation of the MACD, by understanding more about how the MACD indicator works, you'll be better positioned to avoid getting fooled by its false signals or lack of signals, such as when the price turns, but the MACD doesn't provide any warning. So let's discuss about the main issues with the MACD divergence. First, MACD divergence after a sharp move. Monitoring the MACD indicator in relation to the price action reveals a few problems which could affect traders who rely on the MACD divergence tool. A divergence pattern between the two MACD lines will almost always occur after a sharp price move, whether higher or lower. Determining whether the price move is sharp, slow, large or small requires looking at the velocity and magnitude of the price movements around it. Price momentum can't continue forever, so as soon as the price begins to level off, the MACD lines will diverge, for example, go up even if the price is still dropping. After a strong price rally, the MACD divergence is no longer useful. By dropping while the price continues to move higher or move sideways, the MACD is showing momentum has slowed down, but it doesn't indicate a reversal. In this example, the Euro-USD is falling, yet the MACD is rising. Had a trader assumed that a rising MACD was a positive sign, they may have exited their short trade, missing out on additional profit, or they may have taken a long trade even though the price action showed a significant downtrend and no signs of a reversal, meaning no higher swing highs or higher swing lows to indicate an end of the downtrend. That doesn't mean divergence can't and won't signal the occasional reversal, but it must be taken with a grain of salt after a big move. Since divergence occurs after almost every big move, and most big moves aren't immediately reversed right after, if you assume that a divergence in this case means a reversal is coming, you could get yourself into a lot of losing trades. Second, problems with divergence between MACD highs or lows. Traders also compare prior highs on the MACD with current highs or prior lows with current lows. For example, if the price moves above a prior high, traders will watch for the MACD to move above its prior high. If it doesn't, that's a divergence or a traditional warning sign of a reversal. The signal is also related to the problem discussed before. A lower MACD high price level shows the price didn't have the same velocity it had last time it moved higher. It may have moved less or it may have moved slower, but it doesn't necessarily indicate a reversal. As discussed before, a sharp price move will cause a large move in the MACD, larger than what is caused by slower price moves. An asset's price can move higher or lower, slowly for a very long periods of time. If this occurs after a steeper move, meaning more distance covered in less time, then the MACD will show divergence for much of the time the price is slowly marching higher, relative to the prior sharp move. If a trader assumes a lower MACD high means the price will reverse, a valuable opportunity may be missed to stay long and collect more profit from the slower increase higher. Or worse, the trader may take a short position into a strong uptrend with little evidence to support the trade except for an indicator, which isn't useful in this situation. This example shows a downtrend. The downtrend is caused by sharp downward moves followed by slower downward moves. This results in divergence when the next price wave isn't as sharp, but in no way indicates a reversal on the MACD. MACD divergence was present this whole time, yet the price dropped all day. If monitoring divergence, an entire day of profits on the downside would have been missed. Another problem with watching for this type of divergence is that it often isn't present when an actual price reversal occurs. Therefore, we have an indicator which provides many false signals. Divergence occurs, but price doesn't reverse, but also fails to provide signals on many actual price reversals. So having these two MACD problems in mind, how you improve the accuracy rate of spotting divergences correctly using this indicator? I use 3 steps. The first one, it's safe to say we must focus on the price action first instead of divergence. For a downtrend to reverse, the price must make a higher swing high and or a higher swing low. To reverse an uptrend, the price must make a lower swing high and or a lower swing low. Until this occurs, a price reversal isn't present. Whether divergence is present or not isn't important. Traders make money off price movements, not MACD movements. The second step, I look for double divergence patterns, meaning I want to see a divergence on both the histogram and on the signal and MACD line. Third step, with the creation of a double divergence on the charts, I prefer to draw a trend line on the charts and enter after a breakout. This way, my stop loss is optimized below or above the breakout, and the entry points are clearly identified. Keep in mind that a trend might continue over an extended period even after a double divergence, so it goes without saying that your stops should be in place at all times to act as a safety net against any potential misreadings or miscalculation of risk. Another interesting factor to notice in the case of a double divergence is the volume, which will decrease when the second divergence is underway. Thus, it is a point where the momentum and the volume seem to arrive at the common grounds to represent a specific price action phenomenon. Here's Visa on a 15 minutes time frame. We have a first divergence on the histogram here. The second divergence on the MACD lines here. The market was making higher highs and higher lows, so in order to trade the double MACD divergence, we needed the price to record a lower low, which it did, and at the same time, we had the third step completed as the trend line marking the uptrend was broken to the downside. With all 3 conditions met, a short trade after the breakout was a high probability trade. So we combined price action with the MACD to find a decent short trade. The same pattern, but on a downtrend. The histogram divergence, the MACD line divergence, a higher swing high, and the downslope trendline breakout. Perfect entry. Here are other examples of double MACD divergence trades. It goes without saying that a price action needs to be followed after you're in a trade. It doesn't mean that you have to be up and awake in front of the screen all day, monitoring every pip move. But at the same time, you must remember never to lose sight of the primary levels and how they need to be capitalized in conjunction with a new trend in the market, which hopefully started after the MACD divergence. And remember not to have irrational expectation from the market. Set up realistic profit and loss targets and work towards realizing the profit. I like to use this double divergence system in my day trading activity, but it can also be used as a swing trading tool. If you learned something new and found value, leave us a like to show your support, and don't forget to subscribe and hit the bell icon to stay in touch with new uploads. Until next time.